Let's break down the statement of cash flows, my favorite financial statement, into 3 sections, starting with the first one, cash from operating activities. We begin with net income. That comes from the income statement. Then we have to adjust for non-cash items because remember, we're trying to figure out the change in cash. Then we calculate changes in net working capital, and that comes from the balance sheet, measuring the change from one account to the next period over period. Accounts receivable, inventory, and accounts payable, just to name a few. We look at all these changes, we add them up, and we arrive at cash from operating activities. In other words, the amount of cash that comes from the core operations of the business. Then we move on to the second section. This is cash from investing activities. So when you go out there and you buy a truck, a trailer, a building, or you invest in a business, those cash outflows are recorded here. Also, if you sell a business, you sell a truck, you sell a tractor, those cash inflows will be recorded in cash from investing activities. Then we move on to the third section. This is cash from financing activities. So think about it. When you go out there and you get debt or you raise capital from an equity provider, those cash inflows will be recorded in cash from investing activities. And when you pay down your debt or you return money to your investors, those will be cash outflows in financing activities. So you take cash from operating activities, cash from investing activities, cash from financing activities. You add it all together to figure out your change in cash. You add that to your beginning balance and you arrive at ending cash. And the beauty of all of this is it ties back to the balance sheet.